Hello there everyone, today's video is all about corporation tax and this new hike in corporation tax that is now in, the dreaded 25%, although it's worse than that because the marginal rate, as I've told you before, is 26. But this video is not so much on the fact that the rates have increased, we know about that, it's more about a separate yet linked part of the new rules which talk about associated companies. So let me explain. This new hike in corporation tax basically says that profits of up to 50,000, 19%. Now that's what the rate was before, 19% on any size of profit. Now it's the first 50 grand. Then when you get beyond 250,000, the rate is 25%, and anything between 50 and 250, it's in excess of 26%. But what, and that's upsetting enough, but what has sort of flown under the radar, I would suggest, is this secondary rule that's come in at the same time, which says those limits, the point at which it goes up at 50 grand profit, and then again the other limit of 250, you can divide those by the number of associated companies that you have. So in other words, if you've got two companies that you control, the point at which the new corporation tax rise bites is that much sooner. Now, unfortunately, this is going to affect a lot of people because classic advice for so many entrepreneurs before the new rises in tax came in was to actually go ahead and create a second company for asset protection, a so-called topco. You insert a holding company, park some assets, some machinery, some cash up there, and it's ring-fenced from your trading subsidiary if, God forbid, anything should happen and someone should sue your trading business. But now, unfortunately, that could result in more corporation tax. So let's just have a look. As ever, it's in the numbers. So let's assume mum and dad got a limited company making widgets and they're earning profits in the company £200,000 a year. So 200 grand a year. Now, under the old regime where it didn't matter how many companies you had, everything else, flat rate 19%. So 200 grand would have given rise to £38,000 corporation tax. So now what I want to do is just assume, fast forward to right now, and let's just compare the tax that they're now going to pay under the new regime with having two companies as opposed to one. So yes, we know they're going to pay more than 19 because the rate's gone up. But what is this impact of having two companies versus one company? What does that do to their tax bill, notwithstanding the fact there's been a rate rise? So, pretty standard sort of group structure. Mum and dad at the top, they own Topco. Topco owns 100% of Trading Co, making their widgets. This is the tax-paying entity, if you will. The trade profits are made here. This company pays corporation tax. Post-corporation tax dividends go upstairs to Topco. They arrive in Topco, absolutely tax-free, and then they're paid out to mum and dad, and they pay income tax up here. No tax paid on the receipt of dividends. The only tax that Topco would pay is on its own self-generated income, i.e. if there was money parked in investments, the yields on investments, if this was rental income or dividend income from its own interest income, rental income from its own investments here, that would pay corporation tax. But assume most of the income coming in here is tax-free dividends from the subsidiaries. So let's have a look at tax take now under the new rules. So let's just assume, first of all, that they didn't have Topco. It was just mum and dad owning one company. 200 grand a year profit, first 50,000 at 19%, as I've said. That's 9.5 grand of tax. Then the next 150 grand, because they've got 200 grand in total, the next 150 grand is taxed at 26.5%. Now that's the real kicker. The fact that for every pound you're making over 50 grand in the company, you're paying 26.5 pence in the pound as tax. We work that out, it's 39,750. So when you add up all the tax, it comes to just shy of 50 grand. To be precise, 49,250. So that's an overall effective tax rate of 24.6%. Total tax divided by total profits, 24.6. And because that's less than this new 25%, the government say we are giving you what they call marginal relief, which is a bit of it's a cute way of putting a spin on it, because yes, overall you're paying 24.6% of profits, but you've had to suffer 26.5 in the margin. 19 on the first 50, then 26.5. But overall, the effective rate is 24.6. But this is the kicker though, there. For every pound you earn in excess of 50, paid 26.5. Now, and I've done videos on this before, but let's now assume that we've got this full structure in place. What does it mean now that they've got Topco from a tax point of view? We know commercially it's great, they've parked assets, ring-fenced, trading company, protected from all the valuable stuff up here. But what does it mean from tax point of view? So, the rules say you divide the limits by the number of associated companies. So, the number of companies they control. So, in this case, same set, husband and wife control 2 companies. So our 50 grand limit and our 250 grand limit, we need to divide those by 2. So 25 grand profits at 19%, not the first 50, the first 25. And then the 26.5 grand incremental rate, the dreaded 26.5% band, kicks in that much sooner at 25 grand, not 50 grand. But then, of course, you come out of it that much sooner and drop back to 25% once you get to 125,000, being half of the 250. So you start paying a higher amount, that extra incremental that much quicker, but then you drop back out of it, but you're still dropping out of it into a 25%. So let's have a look. So 25 grand at 19%, 4,750. Then you've only got 100 grand in the 26% as opposed to 150 over here. That's 26.5 grand. But then you drop back to the 25%, 75 grand, 18,750. You do the maths and it comes to a straight 50 grand, which is to be expected. And it should do. That's the check, because the new rules say it's not like stamp duty where you kind of say, well, we're going to pay X at this amount, then the next slice at this amount, then the next slice at this. It's kind of like an all or nothing. Once you get to a certain level, the whole lot is at that rate. And this level here, this 200 grand, even though the 25% kicks in at 250, because of the 2 companies, it kicks in at 125. So the 200 grand profit busts that upper limit. So they are straight into 25% on the whole lot. So that's like a check of the calculations right, and it is. So the 50,000 tax on 200 grand of profit, 25%. So in pounds, shilling and pence, what is the actual cost in extra corporation tax of having this group structure as opposed to just having one? 750 quid on a 200 grand profit level. So I would suggest that ain't too bad, because this is still a good idea. This has never been a tax play anyway. This is all about protecting assets. If you built up surplus cash, you don't want to pull it out as dividends. You want to just leave it in a corporate wrapper, invest it on property or stock shares, whatever. Getting it upstairs, moving kind of machinery, expensive kit upstairs, ring fenced up here. If this company gets sued, it doesn't affect that. That, to me, is still worth an extra 750 quid a year. So yes, you're going to pay more tax by virtue of having 2 companies instead of 1. But I think at this sort of level, it ain't so bad. Yes, it's going to be different on higher numbers, but you know, I would say it's not that bad. It's not a game changer. Certainly at that kind of level, you would still probably press ahead and do that if you haven't already done so, and that option is on the table. Again, depending on the nature of assets that you hold. If you were just having one company, I don't know, maybe it's a lifestyle company and you strip out everything post-corporation tax anyway, well then there's no need to have a top co. So it's horses for courses. If you don't strip out everything you earn and you want to leave it invested in a corporate wrapper, then I would suggest crack on with this. Yes, you're going to pay a bit more tax, but it's still overall it's worth doing. Right. So what else? Yeah, divide by the number. So if you've got another company knocking about, let's say mum and dad have got something over here, they've got a separate business unconnected, but because they've got the common directors, again, that would come into the mix, and you divide the limits by 3 instead of 2. So it's all about the number of associated companies that you have. And like I said, this company, if it had income in its own right because of yields on investment returns, then yes, that would pay corporation tax, and that would pay the higher rate again that much quicker than if it being standalone by the fact that it's associated with another company. But just bear this in mind, because whilst this increase to 25% and the dreaded margin at 26 has been all over the press, and for actually the margin, not many people do or still familiar with that. Certainly people know about the 25%, but it's the incremental step change from 19 to 26 that I think people are still not quite sure of and need to know about it. But it's this associated company rule which hardly anyone, I would argue, have really thought about, and it does impact. But like I said, you've got to crunch the numbers, because on certain levels, certainly on the random number that I've chosen of a typical SME company making 200 grand, they're not making millions, they're not making modest amounts, somewhere in the middle, it's going to give Ma and Pa a nice lifestyle, I would suggest. But on the 200k profit level, it ain't so bad. 750 extra tax for the ability to ring fence valuable stuff, get it parked up here. Not too bad. I would go with that. Anyway, just something to think about. If you are if you're not already in this space and you're thinking about inserting a top co, crunch the numbers. If you're already in a top co, again, how much extra tax are you going to pay? Would you want to collapse that structure? Maybe not. Again, everything's individual. It depends on your circumstances. It depends on how much valuable stuff you've got within that corporate wrapper that you want to ring fence, but you don't want to take it out of a company because you're going to get hit for large dividend tax. So food for thought on the new corporation tax rates, especially around what we call associated companies, the number of companies that the shareholders control. So if you like this video, please do subscribe, and as always, I'll see you soon.